Hey traders, and welcome to Smart Risk. Crypto markets are heating up. Bitcoin has smashed through its all-time high, crossing $124,000. But it's now losing dominance day by day, signaling the early stages of altcoin season. And that means massive opportunities ahead. Most crypto investors only focus on fundamentals and completely ignore technical analysis. And that's a huge mistake. In this video, I'll share a powerful trading plan built on technicals, with clear, easy-to-follow steps designed to help you secure the best possible entry points, even in the middle of a bull run. Because it doesn't matter if you're buying to hold long-term, trading spot, or using leverage, your entry price is always the game changer. Welcome back, traders. Now, let's start with the basics and see how supply and demand zones are formed. In a bullish scenario, every time price breaks a high to the upside, it creates an unmitigated demand area tied to the impulse leg. Similarly, in a bearish trend, whenever price breaks a major low to the downside, it forms an unmitigated supply area. So essentially, supply and demand zones are the areas from which price makes a strong, impulsive move that leads to a break of structure. Now, you might be asking, why is identifying these zones so important? Here's the key. These zones are where smart money first enters their positions, often at the origin of a trend. They're decisional areas that form before institutional orders are executed. That's why they carry so much weight. Price tends to respect them. When price comes back to these zones, institutions often step in again to defend their positions. In simple terms, institutional money protects its territory, and that defense is what sparks the reversal. Another big reason these zones are respected, and why price often reverses from them so cleanly, comes down to how institutions operate. Large institutions don't enter the market all at once. Instead, they scale in gradually, often in multiple stages, especially around zones where their earlier trades have already left footprints. This means not all of their original orders get filled during the first move. So, when price returns to the demand zone, they see it as a second chance to execute the rest of their orders, and that's when they step in. That's exactly why we wait for price to revisit these zones. Now, let's move on and see how to correctly draw them on the chart. So here, price is in a strong uptrend, forming several successive higher highs and higher lows. That means we should focus on identifying demand areas. If you look closely, you'll notice that price continues to break previous highs while protecting the lows. Each time it breaks a previous high, a new demand area is formed. Starting from the bottom left, here, you can see price breaking above the most recent high with a single, rapid impulse leg. That breakout creates a demand area at the origin of the move. To highlight this properly, you want to focus on the very beginning of the impulse that caused the break of the structure. This is the exact spot where price was aggressively pushed away. In this case, the last two down close consecutive candles, before the expansion move from the demand zone we were looking for. Once again, we see price forming a new higher high. After a temporary pullback, it pushes upward again and breaks the most recent major high, creating a bullish break of structure. That means another demand area is formed at the origin of this latest bullish impulse. In this case, the three consecutive down close candles before the strong expansion move represent the next unmitigated demand zone. Next, price creates yet another higher high, then pulls back. Notice how it taps directly into the previous demand zone, rejects strongly, and reverses with aggressive buying momentum. This powerful move breaks above the recent high, confirming a fresh break of structure. So, we have another demand area to highlight. Just as before, we focus on the origin of the bullish impulse leg, the point where price actually launched upward. The opposing color down close candles at this origin form the latest demand zone. Now, let's keep going. Next, we see that price pushes lower, and after tapping into the latest demand zone, it changes direction and rallies higher, briefly penetrating the most recent swing high with a candle wick before closing back inside the range. This move is important to break down carefully. Since price did not close above the previous major high, this cannot be considered a valid break of structure. Instead, it should be classified as a liquidity sweep. And here's the key takeaway. In cases like this, when price only sweeps liquidity above a high without closing above it, no new demand or supply zone is created, because there's no actual structural break in the market. What's happening instead is that price is simply grabbing the liquidity resting above that swing high in order to fuel momentum before deciding its next move. So, the red down close candle before this liquidity sweep does not qualify as a valid demand zone, since the necessary condition, a confirmed break of structure, is missing. Now, before we move on to the next topic, if you're finding it difficult to manually identify supply and demand zones on your charts, don't worry. There's actually an indicator that can automatically highlight these zones for you and save you a lot of time. To apply this indicator to your chart, simply go to the Indicator tab, search for MTF Supply and Demand by Flux Charts, and click on it. Once you open the settings, you'll see a wide range of customization options, including the detection method, a sensitivity tab where you can adjust from lowest to highest precision, and the zone invalidation tab, which lets you choose between wick penetration or candle close as your invalidation method. After adjusting these settings to your preference, just hit OK, and the indicator will automatically start highlighting supply and demand zones on your chart. As you can see, it does an excellent job of marking out high-quality zones while keeping your chart clean and easy to read. Supply and demand zones are classified into three main categories: mitigated, unmitigated, failed. A mitigated supply or demand zone is one that price has already tapped into and respected at least once before. Now here's a key point. To determine whether a zone is mitigated or unmitigated, you need to wait for a break of the structure and then check if the price has already tapped into that area after the BOS. For example, in this case, notice how the price didn't reach the demand after the BOS. That means this zone is still unmitigated, because any mitigation that occurred before the break of the structure doesn't count. Another important thing to remember: once a supply or demand is mitigated, your focus should shift to the next zone. This is usually a strong sign of trend continuation. If the next supply or demand is also respected, you can then move on to the following zone, and so on, essentially mapping the structure step by step with the flow of the trend. Similar to order blocks, supply and demand zones are considered a one-time use concept. That means we only focus on them for trading opportunities or analysis when price first interacts with them. Once a supply, demand, or order block has been mitigated, it's no longer an area of interest for future trades. Unmitigated zones are the areas where price hasn't yet tapped into after their formation. They're the most important zones to watch because there's a high probability that price will come back to mitigate them, often leading to strong reactions or reversals. Number 3. Failed zones. As the name suggests, these are zones that price does not respect. Instead, price breaks through them and closes beyond with the candle body in the opposite direction. Why are they important? Because failed supply and demand zones give us crucial insights like which side is in control, where potential market structure shifts may happen, and how to prepare for the next big move. Now, let's explore how you can take advantage of supply and demand zones to build a profitable trading model in the cryptocurrency market. Whether you're an active crypto trader or simply someone looking to invest, there's one principle you must understand. Your entry price is everything. It's the single most important factor that determines whether you survive in the market and whether you make consistent profits. It doesn't matter if you're buying to hold long-term, or you're trading spot, or even using margin with leverage. Your entry price will always be the game changer. This is where supply and demand zones shine. They work exceptionally well in the crypto market and can give you high-quality opportunities, especially in coins with the most liquidity, like Bitcoin, Ethereum, and Solana. So now, let's dive into the crypto-specific version of a supply and demand trading model. Let's say we're in a bullish market and the price is trending upward. That means we're focusing on buying opportunities. The very first step is to identify the most recent unmitigated demand zone on the 4-hour or 1-hour chart. Keep in mind, in the crypto market, supply and demand zones on the 4-hour and 1-hour timeframes are much more likely to hold and be respected by price. Once we've identified the higher time frame demand zone, the next step is to wait for the price to return to that higher time frame zone, and then we zoom into a lower time frame such as the 5-minute or 15-minute chart, looking for price to show any sign of reversal. This could be a market structure shift or a clear change of character. That's your first layer of confirmation. This shift signals that the temporary bearish move is ending, and bullish momentum is likely coming back. At this point, the price is expected to realign with the dominant bullish trend of the higher time frame. Now, once a market structure shift is confirmed, and we expect the price to move higher, the next step is to look for a buying opportunity. At this stage, we focus on spotting a bullish fair value gap, an order block, or an inverse fair value gap formed within the market structure shift leg. These areas often act as magnets, where the price is likely to retrace before continuing upward. To open a position in this case, you'd place a buy limit order at one of the identified entry zones. For example, if your goal is to hold the asset long-term, this gives you an optimized area to enter the market and hold with confidence. But if you're trading spot or margin with leverage, risk management becomes critical. In that case, place your stop loss a few pips below the swing low to protect your capital. When it comes to taking profit, you have two solid options. Target the nearest liquidity pool on the current time frame, or aim for higher time frame key levels if you're looking to capture a larger move. To properly apply this trading plan, you need to use multiple time frames in order to get the highest probability setups. Start with a higher time frame to analyze overall market conditions and identify high-quality supply and demands, such as the 4-hour or 1-hour charts. Then, switch to a lower time frame to zoom in for confirmation signals and entries, typically the 15-minute or 5-minute charts. If you prefer using the 1-hour time frame to spot supply and demand, and then drop down to the 5-minute chart to find any entry point, the 1-hour provides more frequent patterns compared to the 4-hour, which is great for active traders. However, keep in mind that supply and demand that form on the 4-hour are generally more reliable and higher in quality. So, if you decide to work with the 4-hour time frame for identifying supply and demand, then your entry and confirmation should come from the 15-minute chart instead. Now let's put everything together and walk through how to actually execute a trade on a real chart example. Bitcoin 4-hour chart on the screen. As you can see, the overall market profile is strongly bullish. Bitcoin is in the middle of a bull run. Looking closer, you can see that price created a break of structure with this large bullish momentum candle, breaking and closing above the most recent swing high. This tells us that buyers, the bulls, are in control of the market. Based on that, we should expect price to continue moving higher. With this confirmation, our focus shifts entirely toward finding buying opportunities. Next, our focus shifts to the origin of this bullish expansion move, the very move that initiated the latest break of structure. This origin point has formed a demand area. Notice that I'm not highlighting these two down close candles here. If you look closely, you'll see that price already dipped below this red candle, with the wicks of the following green candles. Since I don't consider more than 3 candles when defining supply and demand zones on the 4-hour chart, I simply mark the zone starting from the lowest point of the expansion move, its true origin. This leaves us with a fresh, unmitigated demand zone. And this is exactly where we want to keep our eyes. It's an ideal area to look for long opportunities if price pulls back into it. Now, let's play the chart forward to see what happens. As you can see, price taps into the zone and shows rejection. At this stage, I zoom into the lower time frame, in this case the 15-minute chart, to closely track price action within the 4-hour demand zone, and look for any signs of reversal, and refine a suitable entry point for a long trade. Now, here on the 15-minute chart, if you look closely, you can see that after tapping into the 4-hour fresh demand zone, price rejected and formed market structure shift by breaking and closing above this 15-minute swing high. This tells us that selling momentum is fading, buyers are stepping back in, and price is likely to realign with the 4-hour bullish trend. Once the bullish structure is confirmed on the 15-minute chart, we expect price to push higher. The next step is to look for an entry point for a long trade. This could be a fair value gap, an order block, or an inverted fair value gap that formed within the market structure shift leg. If you look closely, you'll notice that price has created a bullish fair value gap inside this structure shift leg. This area often acts like a magnet, pulling price back before continuing to the upside. So, in this case, I'd set my entry at the highest point of that 15-minute bullish fair value gap, using a buy limit order, and simply wait for it to be triggered. If you're buying to hold as a longer-term asset, your stop loss should be placed below the 4-hour demand zone. But if you're trading spot or margin with leverage, you'd want to set your stop loss just below the 15-minute swing low. Now, let's see if our trade plays out successfully. As you can see, price dipped lower, tapped into our buy limit order, and then shifted direction, pushing higher exactly as expected. This confirms the effectiveness of combining higher timeframe demand zones with lower timeframe confirmations for sniper entries. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.